the economy will continue to improve. Now, many of you would love to know exactly when the next rate increase is coming and how high rates will rise. The simple truth is, I can't tell you, because it will depend on how the economy actually evolves over coming months. The economy is vast and vastly complex, and its path can take surprising twists and turns. What I can tell you is what we expect, along with a very large caveat that our interest rate expectations will change as our outlook for the economy changes. That said, as of last month, I and most of my colleagues, the other members of the Fed Board in Washington and the presidents of the 12 regional Federal Reserve banks, were expecting to increase our federal funds rate target a few times a year until, by the end of 2019, it is close to our estimate of its longer-run neutral rate of 3%. The term neutral rate requires some explaining. It's the rate that, once the economy has reached our objectives, will keep the economy on an even keel. It's neither pressing on the gas pedal to make the car go faster, nor easing off so much that the car slows down. Right now, our foot is still pressing on the gas pedal, though, as I noted, we have eased back a bit. Our foot remains on the pedal in part because we want to make sure the economic expansion remains strong enough to withstand an unexpected shock, given that we don't have much room to cut interest rates. In addition, inflation is still running below our 2% objective, and by some measures, there may still be some room for progress in the job market. For instance, wage growth has only recently begun to pick up and remains fairly low. And a broader measure of unemployment isn't quite back to its pre-recession level. It includes people who would like a job but have been too discouraged to look for one, and people who are working part-time but would rather work full-time. Nevertheless, as the economy approaches our objectives, it makes sense to gradually reduce the level of monetary policy support. Changes in monetary policy take time to work their way into the economy. Waiting too long to begin moving toward the neutral rate could risk a nasty surprise down the road, either too much inflation, financial instability, or both. In that scenario, we could be forced to raise interest rates rapidly, which in turn could push the economy into a new recession. The factors I've just discussed are the usual sort that central bankers consider as economies move through a recovery. But a longer-term trend, slow productivity growth, helps explain why we don't think dramatic interest rate increases are required to move our federal funds rate target back to neutral. Labor productivity, that is, the output of goods and services per hour of work, has increased by only about 0.5% a year on average over the past 6 years or so, and only 1.25% a year over the past decade. That contrasts with the previous 30 years when productivity grew a bit more than